The breakdown has seemingly just begun, and as you'll see in tonight's analysis, the bearish evidence just continues to stack up despite the rally attempts from the Monday and Tuesday session. Tesla earnings after the close are certainly not helping, so let's keep a level head and build a game plan based on logic for the remainder of this week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So let's begin on the SPY weekly time frame chart just to remind ourselves that we are technically rejecting here a key area of structure. We'll remember this as the weekly double top neckline prior support turns into newfound resistance. And remember also that the double top was what kicked us off into a higher time frame downtrend. We certainly have highs, lower highs, the opportunity for weekly lower highs to be set here at the backtest of that neckline, a very logical area based on structure. And because we're coming from a lower low in the sequence, this was nothing more than a counter trend move in the context of an existing downtrend. This is important to understand because if we take a look at the daily time frame chart here, the trend becomes a little bit more convoluted, right? This is certainly a balance range now, and we'll talk about balance rules in just a moment, but coming into the week, remember that we had lows. Last Friday's pullback technically represented the opportunity for a daily higher low. All we needed was an equal high, if not higher high, and we technically got that on the Tuesday session. Now, please don't misunderstand what I'm saying. There's no indication here for an extremely strong uptrend. Obviously, we closed back down underneath the breakout point, and this rejected a lot of key resistance, right? Our daily 50 SMA rejected there, which is clearly pointing in the downward direction, bearish indication. And also, it was a mostly gap fill reversal. The reason I say mostly is because technically speaking, there's still about 15-20 cents left to close that gap overhead. Really more so just comedic effect there. The fact that we've tried 1, 2, 3, 4 times now, unable to close the gap, but for all intents and purposes, gap fill reversal on the Tuesday highs. And also, just to add insult to injury, let's take a look at the head and shoulders drawing, right? For the most part, this is just a break of the neckline, a retest, and once again, a very logical place for a lower high to be set on the retest of that neckline. If that's not enough for you, let's take a look at the anchored VWAPs from all the major pivots after the October low. And what we know is that there's 2 big cohorts, right? The AI mania cohort up here and all of the more quote, responsible buyers who got involved before the AI mania breakout in this area. So we're rejecting the upper band, the anchored VWAP band there. The AI mania traders are now underwater, quote unquote. The average buyer since the break of the godforsaken range is now underwater. So all of these data points on the higher time frames or zoomed out perspectives really point to a very logical area for the market to be slowing down. And this is kind of, again, important because the overall thesis is that if a weekly lower high is going to be set, the next thing that we're looking for is the daily trend to align with the weekly trend, meaning a daily downtrend can occur if we break down from this balance, right? Because technically speaking, if this was your last higher low in the sequence, all we need is a lower low. And we did make, technically speaking, a nuanced lower low at the bottom tick of today's session underneath 430, but I would start looking for a firmer breakdown of this balance range to kick off the move in the downward direction, aka a failure of 430 to do something like this. A range double, right? Because classically speaking, balance range is typically what we're looking for as a target, is a double of the range. Notice that that puts us underneath, if we're truly going to use the measured move, puts us underneath 425. I think if you move underneath 425, it's signed, sealed, and shipped. We're probably making a move down towards these lows, the lows in the overall weekly trend sequence, 420.50. It's a really weak area. Remember that structurally speaking, from an auction theory perspective, those are not secure lows by any stretch of the imagination. The only bullish thing that I could see happening here is a look below and fail, something that really materializes the exact opposite of what happened with Tuesday's failed break at the highs, right? We technically look underneath the range, maybe find the higher low at 427.50, and then intraday you would need a higher low back above 430 to retarget the top of the balance. That's really the only hope that the bulls have to hang on to, hope for here, but for the most part, supporting evidence does not really align with that thesis. Let's take a look at the hourly time frame chart because I want to illustrate, sure, we can see the balance, it's extremely clear here on the hourly, but let's talk about the dynamic of what happened on Tuesday's gap down. Remember that on Monday into the close, we had extremely bullish high and tight consolidation there, setting up a potential break over this area of well-documented resistance, right? So to see a gap down on Tuesday, not only underneath this, but underneath the opening print of the day's session, the ideal outcome for sellers there would have been a gap fill reversal to kick off a failure from the buyers and then make a move in the downward direction. So the fact that the buyers were able to squeeze and rally back into the range, take out the top and make a higher high, it's sort of like a second offering, right? Fail once, shame on me. Fail twice, shame on you. Buyers are, really, this failure on Tuesday, it's incredibly showing for the strength of the buyers there to not only be able to break the high, but then fail to find a higher low pullback. And now on today's session, notice the intraday lower high underneath 433.65. So I think that this Tuesday failure is more so a nail in the coffin from the buyers. And to me, it would seem as though more of the evidence points to the downward direction, breaking this balance range here, 430 not holding as support and looking for that continuation in the downward direction. What other supporting evidence do we have here before we talk about pathing? Let's take a look at the anchored VWAPs. Again, we're kicking things off with the FOMC breakdown, then this pivot low, this pivot high, and the rally low from Friday of 2 weeks ago. 430 clearly an area of interest, and this also, the retest of that 433.65 can now act as resistance. So from an anchored VWAP perspective, I really see two paths. Number one is just straight up continuation, bounce here, lower high on the rejection retest of the anchored VWAPs, or rally first, reject here, come back down for an equal low in short proximity of time at the bottom of balance at 430, and then create that same descent underneath, looking for continuation. The buyers only have, again, that upper hand if we produce a look below and fail. If this is the balance range, it's an initial drive lower, and then we recapture the 430 mark with a higher low here. That starts to become a little bit more convincing for upside, but you still have to contend with resistance at 433.65. So no matter how you slice the cake, I would tend to be more bearishly inclined based on the evidence that we have in hand and the supporting evidence with, the internal, or I should say, we'll get to internals in a moment, but the indications from the anchored VWAPs and the failure, if we walk through that narrative, of the buyers on the Monday and Tuesday session. Last thing we'll do here is take out the Fibonacci's coming in from the low of the move up to the top of the move, and I just want to illustrate once again, if we do find ourselves underneath 427.50, it's really too much give back of this overall squeeze that it's more than likely that you come back down for the 100% retracement. So a line in the sand, if you're a buyer, there's no ifs, ands, or buts about it. If we're below 427.50, I don't think it's a good time to be a new money long in this market. If we're above it, I think there's the opportunity for maybe a look below and fail, but I would not hang my hat on it. I would still be looking for a lower high here up against 433.65. With that said, let's take a look at the market internals. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, I think that they are deceiving internals this week, unless you really dive into the nuances of what's going on here. Technically speaking, you would look at Monday's volume inflows and say, yeah, substantial, new money buyers, right? Same thing with Tuesday getting very close to that positive 300 million read. And today's session, you would say the exact opposite. Yeah, new money sellers entering the market underneath negative 300 million. So if you're getting all of these conflicting pieces of evidence from the volume flows, I would tend to point down below to the tick, because remember that the tick never lies. If we were technically seeing new money inflows to this market, and this was really bullish consolidation into Monday's afternoon session, then why was it that the cumulative build topped out and went sideways into the close? This is always much more indicative of short squeeze instead of sustained buying pressure across the exchange through the duration of the day. If you're looking for new money buyers to get active, you always want to see your cumulative build make a 45-degree angle straight from lower left to upper right. Same thing holds true on the Tuesday session. Again, substantial inflows? Absolutely. But what did the cumulative tick do? Made one push higher and then actually closed out negative on the day as this pullback was unfolding. So I'm not really convinced that even though we had strong volume flows here and here, that new money buyers are getting active. If anything, clearly the cumulative tick from today's sell side session overshadows any progress that was made on the Monday and Tuesday attempted breaks in the upward direction. Obviously, advanced decline line in trend lower zone today with the attempt to move into trend higher zone on Monday. But, oddly enough, this is kind of mechanical there. Look at the rejections off of 1500. Just like, nope, you're not allowed up in trend higher zone. And clearly a nice recapture on Tuesday of the zero line. But again, today really speaks for itself. And if you dive one step further behind the curtain and analyze the cumulative builds in relationship to this, I think it's fairly clear that we don't have new money buyers. Market profile is always Exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, what's going on here with the value area and point of control, you can clearly see it migrating lower over the span of this week. This one's a little bit overlapping to down. This one is clearly breakaway to the downside. Point of control is also migrating lower, but interestingly enough, value areas and point of control have been more so centralized in their individual ranges, right? That's certainly central to maybe even bordering on the upper 50%, right? This one was certainly in the upper 50% on Monday. And today's session, even though we did see an aggressive breakdown, value area did not shift lower in the overall profile. Neither did the point of control, obviously. So it begs the question, are we really going to see all that strong of a breakdown? It's yet to be determined, but for the most part, market profile to me would be more so an indication that, okay, let's really wait for a firm breakdown of the balance range before getting aggressive, because nobody wanted to commit volume at the bottom of the range, right? If nobody wants to commit at the bottom of the range, then either we're going to bounce off of it, or you will see commitment once we firmly break, and then people unload on the lower high underneath. So I'm watching that quite closely here. One interesting thing is that we did repair the extremely mechanical top up here. Not only was it lack of material excess on the Monday session, but if we look left, remember that this was incredibly just mechanical with the equal highs here and here, poor high on that session in the past. We repaired that on the Tuesday session, but we also left a poor high in its wake, also in need of repair. So market profile tells us to keep a little bit of an open mind here, being patient for the firm break before getting definitively bearish. And if we do stay within range, it wouldn't be unreasonable to repair this poor high at the top on a look below and fail. The last thing I will leave you with here before we move along to our QQQ is that we do have a spike on the market profile. So M period down here at the bottom is the spike. If we open within the spike, you are balanced and neutral, waiting for a reaction at the top or bottom. If we open above the spike, then technically we are rejecting these lower prices and the market should move in the opposite direction, aka it's the beginnings of a look below and fail. And then if we open underneath the spike tomorrow morning, then we should look for the market to auction lower aggressively, noting that the only reason we really stopped here is because of the 4 p.m. bell. So with Tesla earnings pushing prices in the downward direction slightly, if that's exacerbated into the opening on a gap down tomorrow morning, in my eyes, would kick off some serious sell side pressure. And I do think that you would clearly see the value area, dramatically migrate lower with price if we do get a gap down tomorrow. If we're opening in range, I think that balance is the MO. Taking a look at the QQQ weekly time frame chart, this one is not out of the woods by any stretch of the imagination. Just remember that we do have a resistance trend line here. The only thing going for the QQQ on the weekly time frame is that you might start to consider this a fake break to the downside. Look below and fail from a weekly balance perspective, noting that we never actually got an aggressive weekly close outside of the low from what you might start to consider an equivalent double top on our SPY that we were just talking about. Again, there's still that resistance trend line that you have to contend with, but it's not as bearish from this higher time frame perspective. The most bullish thing that could happen in the QQQ would be some sort of higher low that gets set here, and now all of a sudden the weekly trend is trying to flip back in the upward direction. We'll recall this level as 357 and see that more closely on the daily time frame chart. Let's go there now and throw on the drawing set. What you'll notice is there is the 357. That's the weekly higher low that we need to hold if a stronger breakdown does happen. And on the daily time frame chart, we're definitely in more so of a downtrend on the QQQ daily as compared to the SPY, which is in balance on the daily time frame chart. So it's almost like they're swapped between time frames and trends and what's unfolding. Nonetheless, on the QQQ daily, what we're looking for is an attempt for a higher low to remain over the top of this prior balance range down below. This was a 3-bar range, and technically speaking, those were inside bars of the Friday breakdown from last week, and today's session did technically make a lower low. So the balance has started to break in the downward direction, but we're breaking down into a very clear area of potential support. The line in the sand there is at 361.50. If we can hold above that, it again would offer some sort of not only daily higher low, but just by the nature of being over 357, also a weekly higher low. And then we would look for the equal high closer to 371. Aside from that, on the daily chart of the QQQ, incredibly difficult to look at. Again, the 3-day balance that had formed back here, not very clean trading pattern. So let's take a look on the hourly and see what else we can dissect. You're still getting that same gift from the buyers get a gift on Tuesday's session with your test lower. That's where we produce an equal low back into the range. Notice that we never actually get close to this area. so there was no attempt to flip or stay in any sort of stronger hourly uptrend. The hourly downtrend is much more so intact here over on the QQQ with lower highs kind of stuck, and of course we did produce a lower low on today's session. So the game plan going forward over on the QQQ is a little bit more straightforward. We don't have to deal as much with the balance range when we get to the more micro time frame like the hourly. So if we do get a counter trend rally, it's exactly that. It's a counter trend rally in the context of an existing hourly downtrend. And also, this is at key daily support, right at 361.50. So it wouldn't be unreasonable with an hourly hammer here with a little bit of a lower wick on that daily bar. If we can stay over this kind of zone, or if we can take out the hammer high, wouldn't be unreasonable that recapturing prior low kicks off a rotation back in the upward direction to set a stronger daily lower high up against 366.75. That would be the first place, noting it's the pullback low from the Tuesday session and also today's intraday rejections for that lower high, 366.75. Beyond that, I would say that the line in the sand for your lower high is at 368.50, because that, of course, is your neckline of this as an hourly head and shoulders, right? As long as you're underneath that, you still have the opportunity for a daily lower high to be set from here to here. Anything above that starts to become a little bit more neutral. And remember also that in the back pocket, the bulls are hanging on to some sort of attempted daily higher low. What you'll notice here is the blue 50 SMA on the daily time frame chart projected to an hourly chart, right? And we've slipped that and failed that on today's session, which is also stacking up as a little bit of a bearish data point here. If we throw on the anchored VWAPs from an intraday perspective, what do we see there? And again, no surprises. We're kind of sitting at this key inflection point to the downside. So I would not be surprised at all to see the QQQ attempt to find support here around this 361.50. Any sort of attempts for higher, again, you're looking for a lower high to be set, and then an equal low in short proximity of time is where the door is open. This, just like the S&P, did produce a spike into the close. So if we do open on a gap down underneath 361.50, I think you're looking for a gap fill reversal, then the rotation to the weekly level at 357 that we were just referring to. And clearly you can see it was the midpoint of this prior balance as well, has some structural significance from that perspective. Let's throw on the Fibonacci's from here to the top, of course, and you're at your 61.8, furthering the case that if this level does break, if we gap down underneath 361.50, I do think it, of course, is much more of a bearish indication, opening the door for that further rotation in the downward direction. What would we say is the most bullish outcome here? It's really got to be a stronger recapture of this area at 366.75, not just because it's the 38.2, not just because it's the daily 50 SMA, and not just because it's the anchored VWAP from here, but from a pattern perspective, if you're going to reverse the curse, so to speak, of the hourly downtrend, you need to find a higher low. And again, not everything's a head and shoulders, inverted head and shoulders, I get it, but wouldn't that be an ideal higher low here to kick off the opportunity for a move in the upward direction? If this is the case, if we do see some sort of higher low, really strong rebound up over that 366.75, I would be open to the idea that the QQQ is attempting to show us a big time daily higher low and a weekly higher low, attempting for a stronger reversal. Unfortunately, I don't think that there's enough supporting evidence to make that a primary outcome. And the primary outcomes, once again, would be a lower high here or just a gap down for a gap fill reversal underneath 361.50. This level, once again, 366.75. I know that there's lots of stuff on the screen there, potentially making it difficult to look at. Let's take a look at the hourly time frame chart and see what not hourly time frame chart, but rather market internals for the Nasdaq side of things. Notice that you do not have substantial inflows on the Monday or Tuesday session, not even close on the Tuesday session, unlike what we saw over on the NYSE, and substantial outflows on today's session. So much more of a bearish edge from that perspective, certainly in trend lower zone on today's breakdown. And you did get a little bit of a stronger cumulative read over on the Nasdaq side of things, but look at the devastation today. And once again, cannot hold up whatsoever on the big rally attempt from Tuesday, closing basically flat out of the cumulative tick. The tick today closing at negative almost 9,000. Very, very substantial read. Remember that 5,000 positive or negative is usually the read that we're looking for. Net flows on the week have neutralized as compared to the NYSE side of things, which were technically still net positive. So overall, not thrilled with any bullish indications here out of the Nasdaq when you take a look underneath the hood. Once again, I think that this really continues to speak to more of a bearish edge across the broad market. Here's the Nasdaq futures market profile. And what you'll notice here is just the continued migration of value area in the downward direction. Today was finally breakaway to the downside. Points of control are also also migrating lower. But once again, being objective and just looking at the facts in front of us, this is certainly higher in the Tuesday session. This is certainly higher to somewhat central in today's session. Value area point of control did not migrate lower with price, and we do have that spike at the very bottom of the overall move. So begrudgingly lower, trying to be respectful of, if we just go back on over to the platform, the QQQ, trying to be respectful of this area here. I think that the larger dump, so to speak, will happen if we gap underneath that level. All of this turns into overhead supply. We're back in this range, putting any buyers from back here as nervous participants. That's really the nail in the coffin. Underneath 361.50 out of your QQQ for all of the reasons that we just sort of looked through. Let's take a look at let's go back to a daily time frame chart and look at some supporting evidence here. SMH for the semis over on the Nasdaq. What do we see over here? Certainly a breakdown of this level gets interesting for further downside. So watching 143.40 extremely closely into the end of this week. We do have an inside bar, 3-bar bearish play. This actually hit the bearish scanner after the close. And you can see clearly as well that we are not holding up over the neckline of the inverted head and shoulders. If buyers were going to be constructive here, this was the pattern that they were looking for. Today's inside doji at the lows, certainly not constructive for upside. If anything, would suggest downside after a little bit of a pause from our sellers. Lastly, for the QQQ is QQQE for the equal weight, and then we will move along to the IWM. This is your line in the sand, 74.50. If we're over, I guess you tend to be a little bit more neutral from the Nasdaq. If we slip it, I think it's RIP. I think you're looking at a move underneath that 361.50 over on the QQQ weighted. IWM weekly time frame chart, absolutely brutal with the inside inverted hammer, nasty upper wicks back to back, just completely rejecting any sort of attempt to, again, not even get anywhere close to the reattempt or retest, I should say, of the neckline breakdown point from the head and shoulders on the weekly. I mean, this thing is just brutalized in the overall range. We've talked incessantly about how nobody is interested in small caps whatsoever, and it's looking like yet again another brutal week shaping up here for the IWM. The bottom of this overall range, as we know, is closer to that 164 level. As a matter of fact, let's just continue on down through the time frames. Here's the daily. Not much to really talk about on the daily. This is now just a balance range with, for the most part, an equal high. If you want to be extremely nuanced there, technically it is a lower high, keeping the downtrend in place. But I would start to think about the IWM as compressing in range, doing something that looks like this when and if we break it, looking for a little bit of an expansion here outside of this kind of zone that we've established. If we just zoom in a little bit further on this, what's the play? Again, if the buyers were going to make something more impressive happen here, wanted to be double bottom, wanted to be up and over that as a neckline, maybe we would have become constructive over 176.65. Just simply not the case here, and a big failed attempt over the upper edge of this week's expected move. So you could just say that it's coming back down to earth after being extended, but in all reality, if this is just a balance range, there really shouldn't have been much of an issue trying to get it up and over the neckline of that as a pattern here. So overall, this strikes me as, once again, a failure from the buyers. Nobody's interested in small caps, and you'll also notice that we've technically closed back down underneath the double hammer highs, which kicked off this counter trend move in the first place. And again, we tried to hold that on the Tuesday open above 171.85. So for the most part, not seeing anything bullish here on the daily time frame chart for the IWM. Continues to sort of be a lost cause until we see dramatic improvement. Looks like we've already got the anchored VWAPs loaded up, and this is just beautiful because you can clearly see that anything that remains now underneath 173.40 is just, no good. You're looking at another lower high attempt here for the daily chart to remain in a downtrend, the hourly chart to remain sort of neutral or even trying to build out a stronger downtrend, and then of course the equal low rotation brings you to 169. Taking out 169 opens that door. There's literally no structure on the daily or hourly chart that we need to be paying attention to until we get to 164. If we do find support somewhere in here, it's going to sort of be arbitrary in relationship to the prior structure that we were dealing with on the weekly, right? There's really not much until you hit 164. So a pretty dangerous situation if IWM and small caps start taking out 169 in the downward direction. Where would we be constructive on a bullish rotation here for small caps? I think the answer is the exact same as what we discussed over on the daily time frame chart. You really need to get back up and out of this as an hourly balance, even just call it that. You've got to get out of that hourly balance up and over 176.65. Nothing about the chart currently is suggesting that that is a high probability outcome into the end of this week. This clearly just a short squeeze. Anybody who is a buyer looking for continuation, any follow through up and over this, completely screwed on this morning's opening underneath the post, or I should say in the post of the P-shaped profile. We'll see that in just a moment. And any longs, again, just obliterated as we made a new lower low underneath 171.85. So it's not really making sense that we're going to see any strong rally out of small caps anytime soon. If we do see a move in the upward direction, to me, it's just going to be a continued squeeze until we have something more constructive over that level we've talked about endlessly at 176.65. Here are the market internals for the Russell side of things. Again, net flows are still technically positive. No strong inflows on the Monday or Tuesday session, getting up and over that 150. Today, getting close to negative 150, but not technically all the way there. This, again, really speaks for itself, completely getting undone on today's session. Short squeeze, absolutely. Again, look at the cumulative builds here. Nothing really is a 45-degree line into the close. Even worse on the Tuesday session, as that consolidation is taking place, everybody's selling it, right? That's really what this tick underneath the zero line is more indicative of. Squeeze the shorts, and then nobody's interested in holding on to the long, right? Today's session, not bad in the downward direction, but certainly, again, no argument to be made for stronger buyers really participating in the small caps at this point in time. Let's take a look at the market profile. There's that P shape that we were just referring to, opening inside the post and then again making a new lower low. Value area did definitively move lower in today's session, looking at this, as did the point of control, but more so a normal curve on today's session. Not really impressed and thinking, in one particular direction based on market profile. I think that everything else we've covered already for small caps really stands, and it's neutral to bearish until proven otherwise, which will continue to be a headwind for the broad market, noting that small caps have acted like the canary in the coal mine. Let's get even more granular and start looking at the performance of our sectors on the week thus far. The energy sector has led the pack here, up 1.99%. XLP follows. That's consumer staples up 1.25%. This is noteworthy because both of them are extremely lightweight sectors, but more specifically, the XLP is definitely more of a risk-off style sector, and I would say that the XLE is actually rising for the wrong reasons, not economic strength, but rather fear and uncertainty of the global situation right now. So this is more so a risk-off style rotation, especially as on Monday and Tuesday we were trying to break out. It doesn't really bode well for a continuation case of a risk-on move to reverse the trend of the overall market. At the bottom of the barrel, we see the real estate sector getting absolutely hammered, down 2.32%. Being so rate sensitive and seeing a new high out of the 10-year, not surprised there. The heaviest weight risk-on sector, the XLK, it's definitely not as bad as it could be, but it's not good, down about 0.7% on the week. Let's take a look at these structural charts and just make some quick evaluations of what we should be paying attention to. Any higher lows over 89.25, good to go for the reversal over here in the XLE energy sector. It's also your daily 50 SMA. That would continue to be a bullish force for the broad market, but really not for the right reasons. Here's the XLP, certainly higher on the week, but starting to find that shooting star on today's session off of a key area of resistance. Clearly, any opportunity for a weekly lower high to be set anywhere underneath 71. Nothing impressive to write home about over there. What about the real estate sector breaking down? Again, talk about weekly lower highs well underneath the breakdown point from back here. It's going to be a slight bearish drag for the market, but it's also an extremely lightweight sector for the market, not really a make or break style deal. Here's the XLI for industrials, 8% of the S&P as we know, underneath the attempted place where a right shoulder could be built. Again, not everything's a head and shoulders, not everything's an inverted head and shoulders, but if you were going to produce a higher low, that was the place to hold it. Clearly closing underneath on today's session, breaking down from this as a balance range. Certainly seems as though we should be looking for the equal low that is bearish pressure for the S&P. Materials, extremely lightweight sector, not as concerned about this one. Balance range, and we will just treat this for what it is, breakdown or breakout, and we will take it in stride. If it does break to a new lower low, of course that is much more bearish drag considering its lightweight nature. Not as concerned when it's chopping in the range. Big new lower low, definitely a little bit more concerning. XLY, this also being a heavier weight risk on style sector, is in the concerning category. Remember that this attempted to make a double bottom back here, no attempt over the neckline, clearly underneath a descending 50 SMA and breaking down from the upper portion of the range, if you're just going to split it in half, to consolidate down towards the lows. So even though this is just like the XLB, sideways in a range here, I would say that this breakdown is much more meaningful out of something like your XLY, a heavier weight risk on style sector. These lows are incredibly unsecure, so if we do test 156.75, I would be looking for a breakdown and then reevaluating from there. A lower high underneath, kiss this goodbye, kiss the broad market goodbye. If we do find a higher low back above, look below and fail is a fair thing to be thinking about, and the target, of course, is always the upper end of the balance in this case. One step at a time, but for now, does seem a little bit menacing into the end of this week. Here's financials. A weekly lower high up against this level right here is incredibly important because we did actually get some pretty positive results from the bank earnings, and it just was not enough to reverse the curse over here in the XLF. If anything, you just continue your weekly downtrend with a major lower high at a key inflection point here, 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 and also the upper wick of that attempted reversal when the breakdown really was hot and heavy from the SVB. So overall, that's kind of what we're dealing with. It kind of does not look constructive for the broad market at all. XLK, also a weekly lower high attempt. No surprises over here. We talked about the QQQ. We talked about the SMH. Right off the resistance trend line, no surprises. The key line in the sand is 166.50. If we're above it, hangs on to neutrality. If we start breaking down underneath it, again, I would start to think that you want to kiss this thing goodbye. It's really not all that constructive getting underneath 166.50. And what you'll notice as well is that we have an inside bar on today's session. So, inside bar rules would basically tell us, oops, there we go, that this is nothing more than a 2-day balance. If we take out the top, take out the bottom, you're looking for balance rules to be in place. So if this is the balance, rotating for a full expected move brings you back down to this level here at 163.50. Obviously, bearish pressure if we break down today was an inverted hammer, continuous rejections of the 50 SMA. Doesn't give me a warm and fuzzy feeling about any sort of upward rotation into the end of this week. Here's the XLV, what's going on with healthcare. It's playing nicely. It's sideways in this range. Remember that it is the second heaviest weighted sector by market cap, so we do not want it making a new lower low, but it's also D for defensive, so it does not need to be breaking to a brand new higher high if we want to be constructive on the market. So the sideways activity here strikes me as being just fine. XLC, failed break to the upside. This one is concerning. Remember that this, we talked about, should have went. If anything, this as a higher low and then reattempt should have went, and you can clearly see we're right back down at the equal low basically after a lower high underneath 68.10. So if this is going to be a failed break, fake break to the upside, look above and fail, as we know, the target is the bottom end, and once again that is bearish pressure for the S&P. Last but certainly not least is the utility sector. D for defensive, undoubtedly still lower high attempts anywhere underneath 61.40. Not really concerned about this. Even if it does break to the upside, it will not be enough. It will not be a saving grace to really propel the S&P majorly in the upward direction for a trend reversal. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, I think that this still reflects a market in turmoil, trying to look for a little bit of relative strength over here out of the tech sector, but you can sort of erase that with the weakness out of discretionary, as well as the weakness out of financials still underneath a descending 50 SMA. Healthcare trying to perk up, but more so neutral, playing nicely for now, we should say. What's going on with the risk-off style sectors? XLP trying to perk up here, but once again, still a big chance for a weekly lower high. Same thing with utilities. Energy is perking up, but for the wrong reasons. Again, not so much economic strength, but rather uncertainty in the global marketplace for energy right now. Let's take a look at some specialized ratios. The XLK over the XLU, pulling back a little bit. We know that this one has been a little deceiving, so let's go ahead and update that with our SHY in its place. SHY is, of course, the short-term 1 to 3 year treasury, where you can find an outsized return compared to the dividend yield over on utilities right now. And you can see it's rolling over, trying to break back down through that descending 50 SMA, overall in a downtrend, a pretty decent mirror at this point for our S&P down below. If this starts to diverge, that would be a bigger indication you could look for something different down here in the S&P. But if this does roll over, find an equal low, it's pretty suggestive of the same thing down in equities here. Let's take a look at something a little bit more apples to apples. XLY over the XLP coming back down into the range. Look above and fail is on the table. This is not what you want to see if you're looking for a more constructive risk on look to emerge in the market. Let's take a look at the dollar, because the dollar has also been doing something fairly interesting, just consolidating. No aggressive pullback as we continue to maintain this look over 105.65. The longer that it just continues to consolidate, the longer the anticipation builds. Once it breaks that range, that should certainly be telling for the broad market. Considering the context of this overall move higher, does strike me as a headwind for the broad market down below. Supporting evidence is a little bit convoluted as well, considering the global circumstances right now. You can see gold clearly outperforming last Friday. Big break to the upside. It has acted as a safe haven asset, especially moving in conjunction. The CL should not, again, come as any surprise. Big move higher here in conjunction with the dollar higher, right? That's really your sort of classic telltale flight to safety style move. Silver even doing something similar. If you take a look at silver, it is not rejecting for that ideal lower high up against the back test of its flush point here at 2280. So a market in turmoil, a market with some uncertainty, a market reducing its appetite for risk is really what I'm seeing as I start to peel back the layers of this onion. And again, another just clear added indication is the TNX, the 10-year yield breaking to a new high, the highest high we've seen in a very long time. I think people are talking about going all the way back to 2007, the highest high we've seen. I mean, we're approaching 5% in the 10-year. Of course, that's going to act as an initial headwind for markets as a whole. What about the inverted ZT to get a sense for what the Fed is looking at, or rather, I should say, what the market is sort of projecting the Fed funds rate should be? Remember that the Fed usually just follows whatever the 2-year yield does. We've inverted this so it just makes a little bit more sense, rate hike or not. And this breakout would certainly suggest that, hey, with the hot retail sales data that we got, and as we'll see, the GDP from Atlanta Fed now is continuing to move in the upward direction, it seems more likely that maybe there's one more rate hike in the campaign. So let's take a look at the tracker tool now. So still getting higher odds for the pause, which is more likely than not, but look at what's going on with the January timeframe here. Almost 50-50 odds for hike versus no hike, which is different than what the market was pricing in as recently as like 3 or 4 days ago. And that, of course, would be a headwind. Another rate hike would not be good for equity prices right now, considering that the 10-year is basically breaking out to new highs. Again, total probabilities down here, you can see roughly that 50-50 split for the January timeframe. And this is coming on the heels of an incredibly hot retail sales report. But also, if you take a look at the Atlanta Fed GDP now, it's creeping back in the upward direction. Now, please do not misunderstand what I'm getting at here. The Fed does not have a mandate for GDP expansion versus contraction, but it would speak to financial conditions loosening, which is fairly clear if you take a look at something like this. So this chart is the NFCI. It's just one measure of financial conditions, and you can clearly see as we rotate away from the zero line, that represents a loosening in financial conditions, which of course is not what Jerome Powell is after at this point in time if he's looking for inflation to be reined back down under control. Speaking of Jerome Powell, he will be on the mic tomorrow at 12 p.m. So keep your wits about you for a little bit of volatility at 12 p.m. I don't imagine that it makes our day easy, but it is just something that we have to deal with. Unemployment claims at 8:30. I'm sure he will have some comments about the labor market, inflation, and the hot retail sales report from the Tuesday release. Let's take a look at the earnings calendar very briefly, then we'll move into some more supporting evidence. Just, of course, Tesla earnings after the close today is an all eyes on watch. As of right now, it's actually lower in the post market. I did not look at Netflix. I think it's higher, though. I actually remember seeing 390 maybe, which represents a massive gap up. We'll talk about that when we get to the core list of companies. Then TSMC will also be a major watch as we head into tomorrow's session, because this has such an impact on the chip sector as a whole and potentially could forecast what NVIDIA might do down the road a little bit further. Let's jump back on over to the platform and start walking through some of our classic charts like the TLT ratio to the S&P. As of right now, this continues its descent underneath a downward sloping resistance trendline, breaking to a new lower low this week, and that's really not all that helpful. Bonds are just getting absolutely obliterated, so if that relationship is not going to be reflective of a flight to safety, we should look at bonds in relationship to one another, and this instead, I think, tells the story of, hey, not comfortable with risk in equities right now. I mean, the shorter end of the curve right now is massively favored. I mean, look at the outperformance here of something like your SHY over the IEI. You're talking about 1 to 3s versus 3s to 7s. It's clear as day, right? That these are moving against the direction that would speak to strong and sustained risk appetite for equities down below. So that, of course, is a headwind. If we take a look at credit spreads, what are these doing? In the short duration, they're certainly expanding rapidly, but notice in the medium to longer duration, they're actually remaining somewhat tame. So is the market pricing in some sort of, quick and rapid capitulation style sell and then a recovery? Perhaps, noting the difference between the two spreads that you see on your screen here. This is a huge tell as well. If we look at the HYG in isolation, we've basically made an equal low here, whereas the S&P is still trading at a higher low. So you be the one to determine what that ultimately implies for the market. I don't know about you, but I think for the most part, it aligns with the thesis that we've come up with thus far, that lower is probably the preferred path based on all of the evidence, all of the data points that we've been exploring thus far. Let's take a look at Bitcoin. Everybody got all up in arms about the rally in Bitcoin, and most of it was given back. If anything, I'm still seeing the opportunity for a very sloppy head and shoulders pattern to emerge, but you would have to break that neckline closer to the 25K-ish mark. Let's talk about market breadth, because this also is not helping the market here. Notice that we're still well underneath the zero line. This is not what you want to see if you're looking for a more constructive rally to basically reverse the daily trend, weekly trend. You got to get up into the positive territory. Certainly not the case over here in new highs versus lows. What about the SPX A200R breaking basically 3 weeks flat now underneath underneath the 50% mark. Let's take a look at the SPX A50R. Same concept, a little bit of a rebound from oversold territory, and also a point on the SPX A200R is that we did not make it into oversold territory, right? So there is no rebound from that perspective. If you look at the 50R, rebound from oversold, but still underneath the 50% mark, certainly not constructive, again, if you're looking for a stronger reversal. What about the RSP equal weight S&P 500 threatening 140 after just continuing this sort of lower high look? The only thing that's constructive for the buyers, I know everybody hates on the head and shoulders, but there it is. If this is going to hold as a higher low, you got to maintain 140, and based on the failed break up and over these highs on the Tuesday session, I'm not really convinced that it's a high probability outcome. So underneath 140 in the RSP is a headwind for the broad market as a whole. What about the Dow transports? This is where we do have some concerns coming back down again for an equal low after a lower high. If this starts to break down, imagine that it has to impose some more headwinds for industrials, meaning the rotation back to the bottom of its range around 31,750. So overall, not looking great from a divergence perspective, a breadth perspective for the broad market as a whole. Let's start talking about volatility, because volatility also remains elevated. Notice that the VIX itself is bubbling. I would call it boiling, up and over 15, but underneath 2050, just waiting for the steam to blow off the top and then cause a capitulation style sell over here in equities. And if we take a look one step further behind the curtain at something like the VVIX volatility, sure, we got a little bit of a pullback on the Monday and Tuesday rally underneath 103, but we find ourselves right back over 103, which is the precursor level for usually bad things to happen from a VIX perspective and some selling to hit the equities market as a whole. If you're still not fond of that, I've got one more trick up my sleeve, which is the volatility futures. If you look at them in relationship to one another, sharp move in the upward direction, there we go, towards the zero line, getting closer towards a backwardation, and I have updated the contracts. So we're looking at the November and December contracts now, very, very close to backwardation. If this gets over the zero line, just remember that represents more risk in the present day than at some point in the future. Money managers do not like that to allocate capital to S&Ps. You can also see in the one-day VIX down here, incredibly elevated, right? So when this breaks from the range, maybe that'll be a tell, but for now, volatility remains elevated. Credit spreads are an issue. The HYG junk bonds by themselves are an issue. I'm not really seeing anything overly positive. Breadth is an issue, right? Nothing overly positive for the broad market. All right, let's wrap things up with a speed round through the core list of companies. I'm not really seeing anything all of that impressive in Apple. Technically, we had an inside bar on the daily time frame chart. Just as a reminder, this is the hourly here. I would be more constructive if Apple wants to find some price acceptance over 176.50 for an attempt higher. If it does move lower, I'm not thrilled about shorts because there's a very clear path to a daily higher low at 174 at this point in time. As a matter of fact, here is the daily time frame chart. If this is going to turn into a balance range retest, or I was about to draw on the infamous now inverted head and shoulders, your right shoulder wants to be found at the top of this prior balance, at the bottom of this prior balance right here. So inside inverted hammer, but an opportunity to find a higher low at 174, a very clear inflection point out of Apple. Not thrilled about longs or shorts in this particular name. Let's talk about Netflix, because Netflix is gapping up on earnings. In the post market, we're trading right around 390, which puts it up here. Where's 390? Right around in here, which means that we're gapping up and over all of this activity. The reason that this is so substantial is because any shorts in this area are completely burnt as soon as we open on tomorrow's session. So I would be looking for potential squeezes for continuation in the upward direction, or just have extremely very, very mild expectations of Netflix, either sideways to nothing or an aggressive squeeze to the upside. I would not be overly aggressive looking for shorts in Netflix against the grain of the move over even the top of this balance over here on the hourly time frame chart. I think it becomes abundantly clear. I mean, there's 390, which is currently where we're trading in the post market, right? Gapping up and over all of that just screws all of the shorts from this area. So if anything, squeezed to the upside or just muted expectations of sideways activity, I would not be a new money short trying to enter this for a fade in the downward direction. Next up, earnings candidate is going to be Tesla. I have not looked at this one since starting the video sequence here, and what you'll notice is that, of course, it is lower. I knew it was lower. I didn't know how bad it ultimately was, and clearly we are trading down towards that 235. So this will be a headwind for markets, just noting that it is lower overall. If we take a look at the daily time frame chart, we're opening back down closer to this 235. So there's the possibility that a gap fill starts to produce some upward pressure intraday, And then if Tesla can go for a gap fill reversal, that would be a thing of beauty to kick off a breakdown of the S&P balance range that we've been talking about. So Tesla is really a wait and see for tomorrow morning, but for the most part, gapping down here, my first thought would be gap fill, and then some sort of reversal keeps the broad market bearish. If we get some acceptance into the previous day's range, not really thrilled about longs until we build something out a little bit more constructive from a new money long perspective, right? If you're trying to fade that gap, that's a completely different story. Let's take a look at Google. Google is just in a balance range. I think that this one is incredibly clear. Just like the broad market, let's turn off those extended hours. You're just going to be patient here in Google, right? You're looking for something long or something short. You can clearly see the failed consolidation over the breakout point from early this morning. So neutral on Google until we exit the range. Metaverse is a little bit more enticing with the opportunity for something on a retest underneath 319. Something that does this continues the downtrend and clearly just rejects the overhead. You could call that opening range from today's session or just the morning consolidation, right? So a lower high underneath 319 is, of course, bearish, looking for follow through into 310.75. I would only flip bullish on Meta if we can get some more price acceptance here and then go higher low over 324. That was the watch intraday early in the morning. Clearly did not work out. The buyers were not present to continue to make prices move in the upward direction. NVIDIA also kind of in no man's land. If you look at the daily time frame chart, threatening these lows, I mean, sure, is it going to break down and close this earnings gap? I wouldn't be my first thought ahead of earnings. Maybe TSMC would be a larger indication for that. Remember, that's tomorrow before the open, so we'll keep an eye on how Taiwan Semiconductors ultimately does report earnings, but for the most part, not thrilled about what's going on the daily chart here. I mean, there was just such a volatile give back on that Tuesday session. Today is technically an inside inverted hammer. Sorry, not inside, but rather just an inverted hammer on the lows. Again, do you want to be short dead on the lows after retracing 100% of this move over the span of 1, 2, 3, 4 days? I tend to think not, but for the most part, I think a lot of folks are focused on, not to bring it up again, but there you go. There's your head and shoulders, right? A lot of people are talking about that from a weekly perspective on NVIDIA. So 319.25, kind of a line in the sand. If we start breaking down underneath it, your only saving grace is roughly 402.50s. Below that, you're really just continuing to walk your balances to the downside. Next up is Microsoft. This to me is a much more actionable setup. I love what's going on in Microsoft, and this probably is a top tier watch because of this. If this is a balance area, you've already got look below and fail once, look below and fail twice. Now it's just a matter of ultimately breaking down from the range underneath 328.25, looking for 321 as a target. And the reason that this is so attractive is, of course, because we have thin structure off to the left. So I'd prefer not to watch almost anything else on the list other than Microsoft based on this setup right here and what's going on with the interaction point at 328.25. For longs, again, you got to get something constructive up here and then a break in the upward direction. Seems like a lower probability outcome considering all the bearish data points we've covered in today's video. Let's take a look at Amazon. Also an attractive setup for tomorrow's session for a similar reason, but perhaps slightly different. We've already broken down from this as an overhead range into the lower balance range underneath that inflection point at 129 that we've been talking about. Any lower highs that remain underneath, just target the midpoint and potentially the bottom end of the range at 124. So Amazon and Microsoft really strike me as the higher probability trade outcomes or trade opportunities for tomorrow's session. All right, 3 trade ideas and then you are on your way. Qualcomm is up first. QCOM is the ticker QCOM, and what you'll notice is a very distinct daily balance area that has formed here with, technically speaking, a 3-bar play in the upward direction. It's a bullish 3-bar play. If we can take out the top of this range at 112.25, looking for the rotation into 114.60, that would also be shy of a full doubling of the balance range. So that's a conservative target. If the range does ultimately break, you can look for some follow through in the upward direction. I would prefer not to see a downward break considering the location of the indecisive doji as a 3-bar play, but if you are inclined to play the downside, if the broad market is falling off of a cliff, you have 108.50 as the bottom of balance and your prior support down here at 105.70 to act as a target. Primarily though, thinking about this one in the context of a bullish 3-bar play break. Let's take a look at the next trade idea. ABBV is for ABBV. What's going on with ABBV? Certainly a very similar setup, but less so of a balance range that we want to play to the downside. Instead, 3-bar play for higher is a recapture of the 50 SMA and looking left, incredibly thin structure until we retrace back to the overhead supply lows at 152.50. Here it is on the hourly time frame chart. You can start to make potentially the suggestion of a upward sloping trend line, and there's your resistance ascending triangle, whatever pattern you want to technically call it, looking for a break, any sort of confirmed higher lows over 149.50. Again, your target becomes a retracement of the thin structure breakdown to the open of that bar, the bottom of the overhead balance there at 152.50. Last but certainly not least is CrowdStrike. CRWD is the ticker on that one here. here it is on the hourly time frame chart. Then we'll zoom out to the daily. But there's your balance range. This one could go either way. I would really play in the direction of the broad market for CrowdStrike. If it takes out the upside, I would need to have the confidence of a broad market break in the upward direction. If it takes out the downside, again, probably looking for confidence from the broad market. Reason being is on the daily time frame chart, we've just broken out of this as sort of a weekly ascending triangle, if you will, as a pattern. So trying to fight this without the help and support of the broad market is going to be incredibly difficult. Even if it does pull back, there's clearly a path to a daily or weekly higher low at somewhere around 170, 175. So just watching this as a picture perfect, maybe you could call it bull flag up here. Lots of upper wicks suggesting that maybe the break is to the downside, but keeping an open mind and once again, really needing the support of the broad market before trading CrowdStrike directionally here from this range at the top of the overall move. That's going to do it for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Hope to see you all live tomorrow morning at 8:15 in the pre-market prep. And with that said, I wish you a green trading week.